We have a cluster alert. We have overbought clusters on 3 of the 4 major indexes, as well as an oversold indicator, extreme overbought indicator, excuse me, on the 4. So I'm going to break down the extremes that are showing themselves across the charts of all these major indexes, what it means, and how we can trade accordingly, what it tells us to do. It might be a little different than what you expect. So I'm going to break all that down, as well as a trade idea today on a stock that benefits from a competitor in the news. So let's go ahead and get started. Today is Thursday, January the 11th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching today. Welcome to those that found us that are watching for the first time. Subscribe to my YouTube channel by clicking that red subscribe button right down there below the video. You can do that right now while you're watching. Also, while you're there, click that thumbs up icon. That lets me know, hey, that you liked it, that you want me to do it again tomorrow. So one click, really easy way for you to give me feedback on what you think about the video. Scroll down further and comment on anything that stands out to you from today's video. You'll see in the video description there's a bunch of links there. I've highlighted a link to subscribe to our daily email Market Outlook newsletter from Market Scholars. You'll get a lot of information in those newsletters, so subscribe there. Follow me on Twitter for more content in addition to these videos. You see my handle on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet from there. Number one, so that Twitter keeps pushing you that stuff. That's how you benefit, and I benefit because the more likes and retweets it has, the more Twitter pushes it out to everybody. Also join our Market Outlook Facebook community. You'll see the address at the top. There's also a link to the address down below in the description. Click on that, join the almost 800 people that are like you, watching these videos day in and day out, and be able to interact with each other there. All right, well, let's take a look at the market forecast to start us off here on the S&P 500. The momentum line spiked up to 100 essentially because we closed right at the high of the day on the S&P 500. Now you notice, if you look back just here in the last few months, but if you look back over the course of this past year, it might even have to go a couple years here, you notice that the momentum line doesn't spike to 100 very often. Sometimes it will, and you can see, here at the beginning of June, we spiked to 100, went up another day, and then you can see the volatility that came off of that. Now, the intermediate posture had been bullish for just about 2 months when that happened. There were times over here where we got a spike up to 100, led to some volatility right there. Just short term, nothing major, right? Just a few days is all it was at the top there. You can see back here, we got a spike to 100, but coming up off of a bullish cluster. So that's actually kind of normal, led to a bullish trend. And that's the current trend that we're on right now. That happened again with the election. You can see back here, again, kind of at the beginning of an intermediate run, but you can see how that also led to some weakness. So you can see, but there's some other times like this. We had a spike up on the momentum line. We only had a couple of days of weakness before we ran up again, and then had some divergences. And so you can see, these spikes in the momentum line don't occur very often, especially when we're 4 months in to an intermediate, a big intermediate run a long extended intermediate run. So that's a little, it's not a cluster. We didn't get the near-term line up there, even though the near-term line you see is, setting up for the possibility of a divergence. We're already obviously to a higher high compared to this peak that we had, the 1 day pullback that brought the near-term line down, not below 50, but down enough out of the reversal zone to set up the potential for a divergence to occur. And of course, any move down would be basically at that low point that we'd be looking for. And of course, if we go up again tomorrow, we just move these lines up. The posture is the posture. We always have to remind ourselves the posture is strongly bullish. Long-term market sentiment, so the trend, long-term trend is strongly bullish. So we always trade in the direction of the trend, which in this case is strongly bullish. Of course, all these risk factors we talk about, 4-month intermediate trend, spike in the momentum line today, closing right at the high, near-term line, possible near-term divergence, market sentiment up to a level. Again, when we get market sentiment above 80, we typically go flat. So the fact that we're not going flat and that we're actually kind of going parabolic here suggests a lot of froth. Now, Froth, I mean, froth doesn't necessarily mean that this shouldn't be happening, because remember, we never trade on what we think the market should be doing. We trade the market on what it is doing, and what we think it should be doing. It impacts how we manage risk. But we still trade with what it is doing. So we still look for those bullish trades, but we manage risk. So for an example, the Delta trade we made. Delta went up on earnings today, and we talked about in that trade example that normally when we see three red arrows like that, we do a bullish trade. In that case, a bullish trade would have worked, but there was other factors we talked about, higher crude oil prices and things like that opened up the possibility of a bearish trade. But we also talked about the idea being that it would be a smaller position, not only because it was speculative, but because it was counter trend, it would be a smaller position. So a trade like Delta, where the thing really kind of takes off, we take a loss, it hits our stop order, we take our loss, and it's a small loss compared to normal because of the risk factors that were in play. That's what I'm talking about in terms of risk management. More risk factors than normal, manage risk accordingly. So let's take a quick look at the other indexes. The Dow Jones Industrial Average, you can see, did form a bearish cluster. So the near-term line did get above 80. Momentum line did not quite spike to 100, but the idea is still there, and it was a bearish cluster with market sentiment. So that's a little unique there to the Dow Jones Industrial Average. The Nasdaq Composite also formed a cluster. Its momentum line did get to 100. So, and of course, market sentiment included in the cluster here above 80. So very, very overbought. And then finally, the Russell 2000, which had formed a cluster earlier this week, formed another cluster again. And look at that move. Holy moly, did it break out above the high of that candle. You know, is that, I mean, if you look at, we'll take a look at IWM here in a minute, but that's a big blowout, breakout move here. But again, resulting in a cluster. Not all four lines like the others, but a cluster nonetheless. So overbought, extremely overbought across a lot of these major indexes, getting extreme momentum highs, which we've seen in the past, can lead to very short-term weakness. Needless to say, in the long-term chart, we are very, very high up above 50, 200-day moving averages. Again, looking at that MACD, we'll just kind of compare here. Again, the MACD itself is extremely high between the gap between the 50 and 200-day moving averages. But you look at how high we are currently above the 50-day moving average, that's very extreme. And then again, looking at how far up above we are above the 200-day moving average, also very extreme. So, and obviously the numbers are getting bigger over here. Somebody showed me a chart of the S&P. I saw a chart on Twitter about the S&P 500 kind of going parabolic. It wasn't a logarithmic chart, so that's important to know. It's been a little bit more steady when you look at, because the higher the numbers, the higher the moves are going to be. That's just normal. The percentages will be the same, but the absolute figures will be higher, and that's not surprising that we're getting a high number, but we're getting really, really extremely up above the 50 and 200-day moving averages. It makes, again, it doesn't mean that we can't make bullish trades. It just means that the risks are a lot higher here. So how we manage them is much smaller positions than normal on new positions, taking off risk on existing positions, reducing position sizes. And someone also said too, what about, what is he talking about? I saw a question about what are you talking about, being less aggressively bullish? With the strategies we employ, right? We get risk defined. We're not speculative or directional. We say higher probability, and we keep our losses. We manage our losses. So, for example, buying stock, if you buy 100 shares of stock, you got 100 delta. You do a bull put spread, you have like a 10, 15 delta. So we start use strategies that reduce our exposure to upward moves. So when the things do pull back, losing $15 on that first dollar pullback versus losing $100 on that first dollar pullback, now that makes it a little bit easier. Whereas when I'm coming up off of significant lows and we go up $1, I'd rather make $100 than 15. So you can see how there's a tug and pull there when there's more risk factors that are coming into play here, including how high up above these long-term averages we are. You take a look at the 3 green arrow chart, you see the same thing. We are very far up above the 8-day moving average. The 8's way, way, way up above the 17-day moving average. We haven't seen this before. to that extreme. And of course, the stochastics, the moving average of the stochastics, so red line, which takes longer to come, it's getting up to extreme highs. So very, very bullish, trading the trend, but extreme bullish means that as we follow the trend, don't try to counter trend it, because we never trade what the market should be doing. But man, we just reduce risk, because again, it's almost like when you're tightrope walking. When I'm tightrope walking and the line's only a couple feet off the ground, then I don't need any safety equipment. I'm not worried about falling off of that. But if I am like walking between the World Trade Centers, like that movie, then heck yeah, I'd want to be able to try to protect myself, because the risks are much, much greater. Doesn't mean I still can't get across, but the risk of falling and the consequences of that risk are much, much greater than if that line's only a couple feet off the ground. Same thing here. We can still keep going up, but the risk of falling and the consequences of falling can be a lot more dramatic now than we were closer to these moving averages. And so we have to protect ourselves with reduced risk position and less aggressive on the bullish side. So a bullish day all around today on the intraday chart, gapping up to start the day, rising through, gapping above yesterday's high point, rising through this week's high point, easily up above last week's high point. Or excuse me, this would be this week's high point, as well as the 4-week high. So pushing the 4-week high up again, and then finishing at the high of the day. Really cannot be more bullish than that. If we take a look at it over here, you can see 62 million shares below average, so still bringing the average down. But again, we have to account for the gap here in terms of the range. The range is 1.5 points by itself. The gap, we closed at 274.12. The low today, 274.56. So almost a half a point. So almost a 2-point range with a lighter volume. So we put that in context here. Lighter volume, so bringing that down, so bringing that line, that's the 4-week average right there by itself. The 2-point range, however, not so bullish, because remember, we want that line to come down too, and the 2-point range brings it up. That's not there's no resistance here that we're breaking through, so it didn't need to be so bullish. And we take a look, that's on the S&P 500. Let's take a quick look at the IWM, which is really blasted out of orbit. That was a little bit bigger than average, not quite so extreme, but you can see its range today was 2.68 points. Add on a little bit more, so maybe 2 3/4 when you account for the gap, and 26 million traded. So we'll take a look at it on this chart, IWM, and so its trading range here was extremely high, and its volume again above average. Those lines going up are not bullish. As bullish as today was, you typically want the lines to be coming down, like they've been doing here since the middle of December, as it's rallied up with small moves. Now you could argue that there was a resistance, a break above that high point, but really that's not very strong. It's got to have multiple touches to strengthen the resistance. So it wasn't that strong of a resistance. It was a resistance, but not that strong. Not that we needed that much of a move. So pretty extreme move today. And interestingly enough, volatility didn't come down. So we didn't drop back down to 9. In fact, volatility actually bounced up here towards the end of the day, setting up the potential for a higher low point in volatility on an absolute basis. On a relative basis, you can see bouncing up 2 and getting back above 80%. So I had come back down yesterday below 80%, and still looks like it's on an upward march. So volatility is rising. Trading ranges are bigger. They're not smaller, which is what they should do as we rise, as the market rallies. So a lot of that kind of putting some question into, okay, are we just really kind of, falling off a cliff to the upside, where it's kind of hard to sustain that, or are we going to be able to? I mean, obviously, it's kind of going parabolic now. It's going to be hard to sustain that. And we see with a lot of these other indicators, we're not getting confirmation from trading range and from volume on the Russell and from volatility that would suggest that we're just going to keep grinding our way higher. All right, now we take a look at what's driving the price action. As a reminder, again, for more content, make sure you're following me here on Twitter. And I wanted to highlight I always pin today's market outlook tweet at the top. We were shooting for 100. We got it. 110 likes. I really, really appreciate that. Again, that's a like just tells me that you want me to do it again. That's a really one-click way to give me feedback. On YouTube, on Twitter, on Facebook as well. And the more that you do that on Twitter and Facebook especially, the more those two platforms will keep pushing you all of my tweets because you're engaging with them. And then the benefit I get out of it is the more engagement it gets, the more Twitter will push it out to everybody among my followers, even the people who haven't engaged with it. So I benefit from it. You benefit from it. I really, really appreciate it. So let's shoot for 150 now. That's our new goal. We got to 100. Let's get to 150 on subsequent. So thanks again. We'll take a quick look at the calendar here. Inflation was the name of the day, of the game, I guess. Today, you can see it was down. It came down on a year-over-year basis a little bit. It came really down on the headline, and it wasn't energy costs because we know crude oil is rising. It was actually trade costs, which are less sensitive to change. And so the fact that they dropped the most is a little disconcerting, and that brought the economic surprise index down. It brought Fed rate hike expectations down. Just down from where they were yesterday, because yesterday got up to over 70%. So back down today. You can see it on the regular chart here for March. It was, what was that? Actually a little bit higher than 70%. It got up to 70%. I think it finished at 67. But now down to 67.1 as you saw on the graph there. So just drop back down, not significant, nothing major, and you can see the economic surprise index didn't drop down anything major either. The other thing that stood out too was the jobless claims report, which is trending higher. So what really matters here is that 4-week average, and look how the 4-week average is kind of taken off a higher low point and up. And again, this was hurricane sensitive. So we've been forming lower lows, and now we're up to a higher high. Take that out and just kind of smooth it out here. We're up above that high. So so things bring this coming down a little bit. You'd think, okay, well that means that treasuries are probably up and stocks were down. Well, crude oil came down today. It's been doing so well. It pulled back. It started off today really well. Pulled back. You can see small caps, that move on small caps, how much of an outlier that was relative to everything else. But long-term treasuries were down at the beginning of the day. Rallied by the end. They were up. They didn't go up higher than stocks and barely higher than high yield. But with that dollar being weak, that's a big theme, is weakness in the dollar. It made a run here early this week, up to this old high point after bouncing off of or trading near support here. And now looks like it's trying to roll back over and continue to move to the downside. And there's a lot of consequences of that to the downside, including bullishness for gold, which you can see gold was up on the day, gave back some of its gains late as risk took off late. But gold and, of course, energy, the energy pullback still had some gains. But and again, like I mentioned before, emerging markets had pullback. Energy hasn't. And if I were to take a look at this on a 4-week basis, any pullback we get is just a pullback of gains, right? It's just a profit taking. It's nothing trend changing. As a 12% move in 4 weeks is a significant move in crude oil. So that's dropping. You can see now the dollar has the biggest loss in the week. And treasuries, which have been down the most, they're just coming back a little bit, bouncing a little bit. Nothing, again, trend changing, as you see on the daily chart for 10-year yield. Pulling back, and we talked about there might be some pullback from 2.6%. Looks like we're already getting it. But we also talked about don't expect to pull it back all the way below 2.2 like it did last time. Most likely pulling back down to 2.4.5 to 2.5 in this area before trying to find some support here and then bouncing back up. All right, so remember how energy went down today after starting off strong? Well, energy stocks started off strong and never did come down. It came down a little bit, but not that much. So finished the day strong, consumer discretionary, material strong. So and industrials, those are the three areas that benefit from a weak dollar. So that's, again, the dollar's going to be weak. We know how to take advantage. And then consumer discretionary being the other area up above the market here. On the other end of the spectrum, safe haven areas. Safe haven areas are not only lagging the broad market, but are actually dropping and continue to drop. And you can see, in fact, on the email that I send out that has a list of all the overbought and oversold clusters, there was 30, I believe 31 overbought clusters, 35 oversold clusters. And of the 31 overbought clusters, I mean, just about every single sector was represented. Just shows how broadly bullish we are. Of the 35 oversold clusters, there's only 2 sectors. And these are the 2 right here. Utilities, down 8% in the last 2 weeks, and real estate. In fact, those 2 sectors in themselves are showing oversold clusters when you look at the ETFs and the sectors on the charts themselves, whereas energy is up 11%. And we've shown you before that, you know, the S&P as a whole, energy, discretionary, materials, and industrials are all above 2 standard deviations above their linear regression trend lines. So very, very strong moves. What's not participating, at least to the same degree, is consumer staples, again, one of those safe haven areas, and financials. So remember, over the last 4 weeks, if I were to bring this chart back up, over the last 4 weeks, yields have been up. Bond prices have been down, and yields have been up, but that has not benefited to the same degree as these other sectors. The financial sector is up 2%, but compared to some of these compared to the broad market, is up twice as much. And you can see the areas that are pulling it higher, and technology kind of matching the broad market. Since the broad market's mostly made up of technology, it's a high percentage market cap weighted of the market cap weighted S&P 500. All right, so for our trade idea of the day, we'll take a quick look at Costco, which benefited today from the announcement that Sam's Club was closing stores, just out of the blue, closing stores in conjunction with raising minimum wage at Walmart and all that. So really good move today. In fact, you can see close to 3 green arrows, but a spike in volume coming up off the moving average like that. You can see the MACD has come down close to 0, which means these moving averages have converged. So now we expect that they will diverge. Remember, MACD is convergence, divergence. Stochastic's also coming up and getting back up above its moving average. So you take a look at the market forecast for this, and you can see the near-term line bouncing back up, the intermediate line turning up too, which would be a stronger bullish posture because it's already relatively high in the chart. And then, of course, looking at the Bollinger Bands forward, you can see we came down to the lower band. We're pushing up to the top band now, some good volume. The bandwidth suggests there's opportunity for the bands to expand again because of how low they are. And you can see, when I looked at you can see when I had the chart down here, that earnings is coming up here in March. So volatility, you would expect it to start to increase as you head into earnings, because we're still about a month, more than a month away. So we can look to buy an option with that March expiration. Coincidentally, the March expiration, because that's 64 days out. I don't want to go out too far; it gets expensive. But I don't want to be too quick either, because then time decay becomes a bigger problem. So I look to buy that first option. It's under 40 on the delta. That allows me to, it's cheapest, so it allows me to put the whole thing at risk. I can put the whole 405 at risk, knowing I'm not going to take the whole 405 loss. And so we'll throw that on the Analyze tab. And you notice, if we get down below 185, which is that, kind of where that support is, then we don't have to be in the stock anymore, right? It's at 190 right now. It's bouncing. If it were to break back down below this low that I'm bouncing off of, then we can take whatever loss, down here to 105. It'd be about $150 today, and that would add up, as it moves closer with time decay down to a 405 loss. So that's my risk if this bounce just reversed itself to the downside. Whereas if we kept going higher and we got up to 205, which is the 1 standard deviation away, because we are getting 1.5, we're getting 3 green arrows practically, and 1.5 times the average volume. So on an upward trend, so there's the expectations that we can bounce up. So here is at 205 by March expiration. You can see the earnings is right in here. So if volatility were to expand, see, this is a positive Vega trade right there, this 30-31. So if volatility were to expand as we head into earnings, that will actually help this call option even more. So there's potential. We can get the purple line right now at $862 gain. on a $405 cost. And that's a pretty decent reward, especially if we're putting the whole 405 at risk, which in reality we're not, but for position sizing's sake we will. And again, this is speculative, it's bullish, but you notice it's not as bullish as it could be. I could go at the money and get about a 50 delta. I can go further in the money and go for about a 70 delta typically, to give myself a better chance of hitting a good reward to risk ratio. Or I could just buy the stock, which would be 100 delta if I bought 100 shares. So you can see how this is a smaller risk. If the stock were to go down tomorrow, I'd only lose $37 instead of 100 if I own the stock. So you see how I can manage my risk. It is directional, so I'm going to do a smaller position size than what I normally do, also because of how mature the bullish market posture is. But, it's when correlations get low, different things make different moves, and there's a potential because of the news today that this can make a move. And now I've got my line that I can watch on the chart. As long as it stays above that line, then I'm okay. If we were to get about halfway through and we're down here, and I still haven't hit my stop, and again, there is no stop per se because we're risking the whole thing. But if we still haven't broken below 185, which is where my stop on the chart would be, but we're still kind of hovering here, then we can say, okay, I'll just take whatever small loss, whatever small gain I have, because it's not moving fast. And that might eventually get there. But if it's not going, because we need it to move. When you buy call options, you need it to move, and you need it to move right now. If it's not going right now and getting there, then we'll just call it good and look for something else. There's better fish out there in the sea that could potentially make us money in this time frame than sitting here and waiting for this to catch back up and hopefully pass it and get to our target by the time we want it to. So in summary, the markets are strongly bullish, possibly to the extreme, and there's a lot of extremes out there right now, which doesn't necessarily mean that we should be heavily bearish, but definitely raises the risk factors, and they should be accounted for, not in making a lot of bearish trades, some to balance, like we've talked about, to have some balance in our active portfolio, so we're not too one-sided, but definitely in our risk management and what strategy we employ, how long a delta we are, positive delta we are. Ironically, when the markets get more and more extremely bullish, we want our positive delta to be less and less. Doesn't necessarily, we can add bearish trades to do that, but we can also take off and use smaller bullish positions to do that as well. Trade small and do more of those smaller trades instead of fewer bigger trades. That can hurt us if there is a reversal, a sharp reversal. They're not likely, but there definitely could be, especially the more, the higher up we go and we have some kind of blow off top there. So remember to subscribe, like, and comment down below on this YouTube channel. Also remember to follow me on Twitter, join the Market Outlook community on Facebook, and while you're there, remember to also like and share and retweet on those platforms. Number one, to make sure they keep pushing you all that stuff. And number two, to let other people know that this is something that they should be checking out. So that being said, thanks again. Have a great evening, everybody. We'll see you all tomorrow.